Hello everyone, welcome to my YouTube channel, Technology Expert. Today we're gonna discuss about accounting tools, and in detail we are about to know debit and credit in detail. So let's begin the video. Business transactions are events that have a monetary impact on the financial statements of an organization. When accounting for these transactions, we record numbers in two accounts, where the debit column is on the left and the credit column is on the right. What is debit? A debit is an accounting entry that either increases an asset or expense account or decreases a liability or equity account. It is positioned to the left in an accounting entry. Credit. A credit is an accounting entry that either increases a liability or equity account or decreases an asset or expense account. It is positioned to the right in an accounting entry. Here we have the usage of debit and credit. So, whenever an accounting transaction is created, at least two accounts are always impacted, with a debit entry being recorded against one account and a credit entry being recorded against the other account. It is no upper limit to the number of accounts involved in a transaction, but the minimum is no less than two accounts. The total of the debits and credits for an transaction must always equal each other, so that an accounting transaction is always said to be in balance. If a transaction were not in balance, then it would not be possible to create financial statements. Thus, the use of debit and credit in a two-column transaction recording format is the most essential for all controls over accounting accuracy. There can be considerable confusion about the inherent meanings of a debit or a credit. For example, if you debit a cash account, then this means that the amount of a cash on hand increases. However, if you debit an account payable account, this means the amount of account payable liability decreases. Therefore, differences arise because debits and credits have different impacts across several broad types of accounts, which are as asset account. A debit increase the balance and a credit decrease the balance. Liability account. A debit decrease the balance and a credit increase the balance. Equity account. A debit decrease the balance and a credit increase the balance. The reason for these seeming reveals of the use of debit and credit is caused by the underlying accounting equation upon which the entire structure of accounting transactions are built, which is assets is equal liabilities plus equity. Thus, in a sense, you can only have assets if you have paid for them with liabilities or equities, so you must have one in order to have the other. Consequently, if you create a transaction with a debit and a credit, you are usually increase an asset while also increasing a liability or equity account, or vice versa. There are some expansions, such as increase one asset account while decreasing another asset account. If you are more concerned with accounts that appear on the income statement, then these additional rules apply. Here we have revenue account. A debit decrease the balance and a credit increase the balance. Expense account. A debit increase the balance and a credit decrease the balance. Gain accounts. A debit decrease the balance, a credit increase the balance. Loss account. A debit increase the balance and a credit decrease the balance. If you are really confused about these issues, then just remember that debit always go in the left column and credit always go in the right column. There are no expansions. Debit and credit rules. The rules governing the use of debit and credits are noted below. Change to debit balance. All accounts have normally contain a debit balance. Will increase in amount when a debit, which is on left column, is added to them, and reduce with the credit, which is on the right side or right column, is added to them. The types of accounts to these which this rule applies are expense and assets and dividends. Change to credit balance. All accounts that normally contain a credit balance will increase in amount with the credit, which is lying on the right column. It is added to them and reduce with the debit, which is on the left column, is added to them. The type of accounts to which this rule applies are liabilities, revenues, and equity account. Total must match. The total amount of debits must match or equal the total amount of credits in a transaction. Otherwise, an accounting transaction is said to be unbalanced and will not be accepted by accounting softwares. Debit and credits in common accounting transactions. The following bullet points note the use of debits and credits in the more common business transactions. Sale for cash. Debit the cash account, credit the revenue account. Sale on credit or sale on account. Debit the accounts receivable account and credit the revenue account. Revenue cash, received cash in payment of an account receivable. Debit the cash account and in against credit the account receivable account. Purchases supplies from supplier for cash. Debit the supplies expense account, credit the cash account. Purchases supplies from suppliers on credit. Debit the supplies expense account and credit the accounts payable account. Purchases inventory from suppliers for cash. Debit the inventory account, credit the cash account. Purchases inventory from suppliers on credit. Debit the inventory account and credit the account payable account. Pay employees. Debit the wages expense and payroll tax accounts. Credit the cash amount or cash account. Take out a loan. Debit cash account. Credit loan payable account. Repay a loan. debit loans payable account, credit cash account. For moreover, here we have examples of debit and credit. Arnett Corporation sells a product to a customer for $1,000 in cash. This results in revenue of $1,000 and cash of $1,000. Arnett must record an increase of the cash, which is an asset account, with a debit, and an increase of the revenue account with a credit. The entry is something looks like this. Here we have two accounts which are applied. One is cash account and second one is revenue. Cash account is debited here and revenue account is credited with the same amount. As you can see, the balance is equal. Another example, Arnett Corporation also buys a machine for $15,000 on account or on credit basis. This result is an addition to the machinery fixed asset account with debit and increase in the accounts payable, which is a liability account, with the credit. And the entry is looks like this: machinery, which is a fixed account with the $15,000 and it's debited here, and account payable, which is a liability account, and it's credited here because it's going rise. It's going to be increases with $15,000. Debit and credit abbreviations. A debit is commonly abbreviated as DR in an accounting transaction, while a credit is abbreviated as CR in the transaction. Are debits and credits used in a single entry system? Debits and credits are not used in a single entry system. In this system, only a single notation is made of a transaction. It is usually an entry in a checkbook or cash journal, indicates the receipt or expenditure of cash. A single entry system is only designed to produce an income statement. A single entry system must be converted into a double entry system in order to produce a balance sheet. So this was the video for today. I hope you guys like it. If you guys found it useful for yourself, do share with your friends. Thank you.